afternoon, everyone. I'm Pamela Hastings, and welcome to another Barometer Readings webcast. Joining us today, as always, is our Chief Investment Strategist and President, David Burrows, who will be providing us with a brief macro overview, and of course, would be pleased to address your questions at the tail end of the conversation. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. We've got lots to discuss this afternoon, and we're pleased to have David back. We were thrilled to have had Diana Avador and Jim Shatakis, eyes and ears on the trading desk with us last week, but welcome David back to our program. So with that, I turn the conversation over to our one and only David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Great, thank you so much. Look forward to your presentation.
Well, thanks for hosting, and thanks everybody for joining in. We do have lots to talk about. Here we are now in the middle of November. We've talked a little bit about seasonality over the last few weeks. We talked about elections. We've talked about market internals. There's all kinds of stuff for people to consider. And one thing's for sure is that news doesn't come all at once. Market changes don't come all at once. We have to watch for the data to support change. And we've certainly been seeing some of that. So let's just jump in right from the top. For most of you who have been with us on lots of these calls, we do believe that we have been in a structural bull market in equities. Started in the US in 2013 when we exceeded the highs from the year 2000. And we exited a secular bear market. And we've been in a secular bull market since. Certainly, there can be very sharp, short pullbacks along the way, and they are always painful. But the net of it is they tend to be short-lived, they tend to be contained, and they tend to be sort of one step back, four steps forward. The last secular bull market started in 1981. It went until the year 2000, just about 18 years. And certainly there was some sharp pullbacks along the way, but they looked very different than the ones in the structural bear market. And we're always on the lookout for those. If you look at 2000 through 2003, it's a long drawn out affair. It was a very significant percentage point drop. Same 2007 through 2009, the financial crisis. That's the thing that people are always afraid of. But if you look at it, it don't tend to get these often. If you go back to the bear market between 1966 and 82, you had one very, very bad drawdown, 1973, 74. They tend to happen about once every 40 years. The very significant ones. And about 40 years later, we had the financial crisis. It takes that long to build that kind of excess. It takes that long for deregulation to get to the point where people forget the last major financial crisis. And while I know it feels bad, bear markets always feel bad. So let's take a look at it under the microscope a little bit. 1980s and 90s. Number of bear markets that were both combination of price decline and time. And they eventually reset and you were able to work their way higher. You can see in general, the lower bound of the bear markets in a bull market will be held at the 200-week moving average, which certainly was the case through the 80s and 90s. Very different than what happened between 2000 and 2013. We crisscrossed back and forth in a series of declines and rallies, but very significant ones. And then really since sort of 2009, we've been lower bound again by the 200-week moving average. We had the difficult market in 2015-16. That was a slowdown in China. We had the 2018 temper tantrum that took place into the middle of December of that year. You had the COVID sell-off, which was the sharpest and fastest bear market in history. Dropped below, but very quickly retraced and back above the 200-week. And you have this bear market that we've seen, which is a lot like what you saw back in the early 80s and the sharp tightening cycle that we went through back then. But really, it's been no more than that. We put in a low in June. We retested the lows again in June. We retested the lows again in October, and we've worked our way higher over the last 2 months. So we believe we continue to be in a structural bull market. One of the things that we will watch for is that we hold that 200-week moving average, but as it stands, we continue to do that. In the bond market, we think that we started a bear market in bonds in 2020, a very sharp move higher in yields. We've lived in declining yields since 1981 in a series of advances and declines, but generally moving lower. The last time we started a bear market in bonds was in the late 1940s. And again, in fits and starts, yields worked their way higher over many, many years. It wasn't really until you got to the late 70s, early 70s, where you had very sharp run up in inflation. There were bouts of inflation previous to that, certainly 1948 and 49 coming out of the Second World War. There was a sharp bump up in inflation that was short-lived as people went out and wanted to buy things, consume, and the supply chain just wasn't able to supply it. But quickly inflation came back down, and stocks actually between 1951 and 1966, while bond yields were moving higher, had a great bull market, went on 15 years. But what works in rising rates is often quite different than what works in falling rates. And we've lived in falling rates, so people's natural tendency is to wonder when the things that have worked during falling rates will work again. So we keep getting asked about, is it time to buy tech? It's been down a lot. My guess is that we will have fits and starts rallies in tech. But if we have seen a generational low in rates, it's unlikely that the things that did well during falling rates will be what lead to the upside. That likely puts pressure on real estate. It likely puts pressure on high multiple growth stocks. Technology is an example. And it may be assets that are more reflationary in nature that lead. And we look to the market for signaling that that's the case. And that has been as we've gone along. But certainly this bear market in bonds has been a doozy, worst one since 1786. Tough year to be in bonds. We were fortunate to have avoided that. We stepped aside of bonds in 2021 and really had no bonds all through the course of this year, other than some very short-term bonds, which we held for cash purposes. There's the TLT. We know that it has had a very, very difficult year at the worst point, down 48% from the high of April 2020. And we know that 10-year bond yields, after declining for a very long time, reached all the moving averages and the long-term trend. It moved as high as 4.3%. I had it at 3.81% earlier today. In fact, I think it closed at 3.76. And these things are spooky to stock investors when things move that quickly. And it's been a tough year for those that had 60-40 sort of static portfolios where they were buy and hold in the S&P and buy and hold in the bond market, about the worst year on record going back to the 1930s. So this points out the reason why active management probably is important, especially if the largest parts of the index are the weakest parts of the index, which certainly has been the case. Now, structural bull and bear markets apply across all asset classes. We know that commodities were in a structural bear market from 2008 through 2020 during those disinflationary periods. During those periods of time, companies that produce commodities were incented not to invest. They were incented simply to return capital. If you looked at the energy sector, for instance, the value of the energy sector in the US stock market fell by 90% between 2014 and 2020. There was a ton of consolidation. And ultimately, demand picks up enough to create shortages. And we've seen shortages in all kinds of commodities over the course of the last 2 years. Certainly, as the stock market was having its worst 4 months, the commodity markets did pull back, but they were much later to start to pull back and have rallied nicely as markets have started to firm up. But clearly, we believe we started a new bull market for commodities back in 2020, and it's likely to go on a decade in fits and starts. The reason that companies that produce commodities tend to do well in a commodity bull market is it takes a long time to bring on new capacity. And there has been literally almost no investment in new capacity over the last several years. So when we look at a shorter term chart, the last 5 years, we can see that even though certainly commodities pulled back in the spring, stock market was selling off from January through May, June. Commodities were not. They were moving higher. They did sell off in the sharpest part of the move higher in yields, but have nicely reversed. But on the year, the broad-based commodity index is up 27% against, of course, we know quite negative returns for equities. When commodities start to outperform the S&P, it tends to go on for a long time. And we think we are only just beginning in that process. So we think probably an important area to watch, and an area we can add a lot of value because frankly, the commodities, materials, and energy still are relatively small parts of the index. I think basic materials about 3.8% of the S&P and energy about 5% of the S&P, again, speaking to targeting. There's the crude ETF BNO, long bear market in crude from 2014 through 2020, broke out, consolidated during the stock pullback early in the year, but have turned back higher. Real estate as an asset class, after a long period of outperformance, has been significantly underperforming through the course of this year, and one that's likely to be challenged going forward. So let's talk about currency quickly. We touched on the US dollar over the last few weeks, and the sharp run up in the dollar, driven by the Fed's tightening cycle, being more significant than what we were seeing in other countries, moved the dollar higher smartly. 3 weeks ago, we highlighted that after a very significant move higher in the dollar versus the yen, the euro, and the pound, we saw the first sell signal on a point and figure chart, at least signaling correction in this move. So with a combination of a bond market that really sold off sharply and a US dollar that rallied really sharply, of course, that rattled risk assets. Now, over the last few weeks, we've seen the dollar pull back. That was the beginning of the pullback. We talked about this was a chart from our last presentation 2 weeks ago, showing that it had broken trend. And here we are today, having moved a total of a little over 8% lower off the highs from late September. So a combination of yields pulling back and the dollar pulling back has certainly helped equities over the last few weeks. Now, everybody's got an opinion as to what should happen. Everybody's got an opinion as to where people should put their assets. Lots of people believe you have a little bit of money in every asset class, a little bit of money in all the sectors, and diversification will work in your favor. Our view is somewhat different. We think that our job, because we're being paid a fee to be an active manager, our job is to identify market leadership themes. They could be asset classes, like we've talked about energy and basic materials. It could be geographic regions. It could be large cap versus small cap. But there are structural themes in every market that have a tailwind, and there will be areas that have a structural headwind. Our job is to find those with a structural tailwind. Our job is to look for change, new leadership as it emerges, and old leadership as it recedes. So of course, we get a stronger market. We want to look at, say, is the leadership that was strong coming into the market low continuing to be strong? And if there's new leadership, be prepared to broaden the portfolio. And in the event that nothing's working, have an ability to be in cash or have a large defensive weight in the portfolio. So what we're selling to our clients is a very tactical approach. And so I do these presentations to try to make sure that we're demonstrating that we are executing on what it is that we say it is our job to do. We have a process that is repeatable. This is a rules-based approach, and we try and look at it empirically. We know that 80% of return comes from getting to the right asset class and the right sectors within those asset classes. So 80% of returns get to the right neighborhood. 20% of return is identifying specific securities within those neighborhoods to help exploit those structural themes. So we have 2 sets of tests we run to try and identify where the portfolio should live. We have some top-down tests, which help us to identify the right neighborhoods. We take all major asset classes and sectors and themes and geographic regions. We put them through tests looking for areas of the market that are seeing net new inflows of capital. Where's money getting put to work today? We want a tailwind. We want money coming in behind us. Then we run a bottom-up process that takes all of the specific securities we could invest in, and we look for very specific fundamental and technical characteristics, that help us to identify securities that are good, getting better. So we have about 20 fundamental characteristics in the income statement and the balance sheet that we try to find things that show acceleration in things getting better, and price characteristics that would support that view. In other words, is price doing what it should be doing given what the fundamental backdrop looks like? So we run these tests independently, trying to identify the right areas where there are structural tailwinds, try to identify securities that meet our business tests, and where these two line up, securities within groups that we think have a tailwind, that's where our portfolio should live. Now it's dynamic. It's not the same all the time. We have to retest every day to say, do our securities continue to make sense? We only need 20 or 40 to build a portfolio. There's 60,000 we can choose from. So we have to employ a really disciplined selling strategy to make sure we carve out the stuff that doesn't work and hold the stuff that does work. People's tendency is to take a profit on something that's working and be patient and hold on to the stuff that doesn't work. And I assure you, that's just not how you make money. If you make 20 investments, out of 20 investments, 2 or 3 will work out way better than you thought. They make a huge difference and you have to hold on to them so long as they work. 7 or 8 will be pretty good and a bunch won't work. We have to be really willing to carve out the ones that don't work. We do that by using stop losses to make sure that a little mistake doesn't turn into a big mistake. So let's talk about that a little bit. The top-down work is all about finding areas of the market that are showing expanding breadth, where over time more and more securities start participating in a rally. That's a healthy market. That's a broadening market. When breadth starts to deteriorate or the weaklings start to fall away, we want to recognize that. It may be the index continues to look good or the largest companies continue to look good. But if underneath the surface, one by one, the weaklings are starting to fall away, that tells us there's not enough new money getting put to work. Well, there's enough money leaving where risk reward has changed. So we don't want to put new money into any groups showing deteriorating breadth, and that could be at the market level or at the sector level and so on. When we put up our gauges on October 11th, this was around 1 week from the market low, we showed that the percent of stocks in the NYSE that were in uptrends, and we measure that, looking for expansion and breadth, had started to show improvement. These had all been red the week before. The percentage of stocks trading above their 50-day moving average in Canada and globally had started to improve. Percent of stocks with positive weekly price momentum in the US had started to improve. So he said, we have to be willing to consider putting some money to work despite all of the concerns about Ukraine and inflation and Fed tightening cycle and earnings. You can only get an extended bull market or rally by starting with a short-term one. Now, here we are a month later. Percent of stocks in uptrends in the NYSE has moved from a low of 18% to 54%. So over the last few weeks, more and more stocks reversing trend. In Canada, over 40% of companies are now in uptrends. And globally, just about 38% of companies are in uptrends from a low of about 10%. Across these various universes, the percent of stocks trading above their 50-day or short-term moving averages have continued to expand. In the US, almost 75% of companies are now trading above their 50-day moving average. Globally, it's a little over 50%. Percent of stocks with positive weekly price momentum, or the percent of stocks that have upward trajectory in the US, has moved sharply higher and above 80%. So all of these internal indicators show us that the market's health is improving. Now, we don't know how long this goes on for. It's something that we watch every day. Should we start to see some of these reverse, it would cause us to get more cautious. But at this point, it's a step-by-step process. We have to measure this daily, and we've seen significant internal improvement in the market. Now, the month of October, the S&P was up 13.9%, which is why if you have things that have held up against the decline, you don't want to go to zero holdings, because when markets turn, they can be ferocious. So that was the month of October. Since then, things have continued to improve. We know that the month of November over the last number of years has been the best month of the year. So since 1950, very strong returns. In the last 20 years, very strong returns. The last 10 years, November especially strong. So it makes sense to be open-minded to things getting better. So here's where we sit. We made a low and reversed on October the 4th. And since then, the market's been moving higher. We're above the 8-day, the 21-day, and the 50-day moving average. And we're now approaching the declining 200-day moving average. So, of course, we keep that in mind. We'd like to see us be back above the 200-day moving average. And this may, in fact, prove to be some resistance we're going to have to see. But at this point, internally within the market, we see improvement, and some of the themes are quite strong. When we look at volatility, volatility peaked in October around the same level it was at in June. These are the two market lows. In fact, we did have a spike in volatility at the beginning of the year, at the beginning of the sell-off, but we have never gone back to levels like we saw in the pandemic sell-off or the taper sell-off. So volatility has come down and is a more benign area. We watch for signs of a pickup there, but no sign at this point. If you put it in a longer term perspective, of course, we never got anywhere close to what people saw during the financial crisis. So there's all kinds of charts on the internet comparing the current market to the market of 2008. And while it's not impossible this market could get weaker, at this point, we don't see it. And we can't just sit in cash worrying about Armageddon if we are seeing internally the data slowly getting better. So let's talk about leadership. The question always is, were the things that are the things that were doing well during the rally continuing to do well during weakness, or are the things that were doing well through the recent sell-off doing well now that the market is rallying? Is there change taking place? On October the 1st, when we put up our sector charts, where we measure which sectors are doing well and which ones aren't. This is a distribution curve where in each column, you have all of the sectors that have a certain percentage of stocks in uptrend. So in this column, as of the beginning of October, all of these sectors had between 0 and 14% of companies within their groups performing well. In other words, almost everything doing poorly. All of those that are in small letters were showing deteriorating breadth, meaning fewer and fewer stocks in uptrends. So you can see on this distribution curve, almost all sectors had a very small percentage of stocks performing well. The first groups that turned higher, oil, transports, they were the first groups to turn higher. Banks had strong relative performance in green, but still had not shown any improvement in breadth. Oil service had turned higher. The builders had turned higher. Wall Street, that's capital markets, machinery and steel, and chemicals, which was odd if you thought that we were going into a really sharp recession. Those are very economically sensitive groups. But it's not for us to question what's happening in the market. The market digests all of the news and all of the knowledge, and price behavior comes out. Our only comment at that point was, well, interestingly, some economically sensitive groups showing some strength. The average sector had 22% of stocks in uptrends, meaning 78% of stocks were in downtrends. Well, now here we are on November the 14th. You can see a lot of sectors in capital letters, meaning breadth is expanding almost everywhere. The average sector has 43% of stocks in uptrends, where in the previous look, it was only 22%. We've seen a number of sectors show strong relative performance. Of course, the first group to turn higher, oil, now has 65% of stocks in uptrends. But oil, builders, banks, steel, machinery, oil service, chemicals, capital markets, these are all economically sensitive groups that are showing the greatest strength. Transports, insurance, aerospace. So we're seeing expansion in the market. We're seeing expansion in the groups that are performing well. Let's take a look at some of the underlying leadership. So as we know, energy has led the market all year long. The IYE, or Energy Broad-Based Energy Index, is up 66.9% on the year over the last 227 trading days. You can see that in the last week, and as of today, we had a new closing high, exceeding the high from May. Now, first of all, it outperformed all the way through the NASDAQ's decline from December until May. It did eventually get caught up in that sharp move higher in yields, came back to the 200-day, and has continued now to move higher as the market improved. It put in a higher low in the October low in the market than it did in June, showing strong relative performance. And this is the relative strength line, this blue line, showing that it's been gaining strength versus the S&P all year long. Now that seems like a big deal, but on a relative basis, the energy ETF versus the S&P ETF underperformed the S&P from 2008 through 2021. Started to show some improvement through 21 and 22, but importantly has only just reversed this trend, meaning that energy could outperform the S&P for a very long time. It's why it's important to identify leadership as it's taking place, because once it starts, it can go on a long time. And again, remember, energy is only 5% of the S&P, but it's been as high as 20% of the S&P in previous bull markets. So being in this group can make a big difference. We've talked about some of our holdings and how they've been outperforming the S&P, outperforming the energy index like Exxon and Hess and Imperial Oil and so on. And they continue to. Hess made a new closing high today, sharply higher than the highs back in May. Exxon is the same. Again, the reason that commodity bull markets go on for a long time is when you go through a bear market, capital spending gets pulled back and is slow to start. We know right now there is less drilling taking place than there has been in a long time, despite the fact that oil prices have moved higher. Well, that means that probably the outlook for oil and gas service companies and equipment companies is getting better. The XES Spider S&P Oil and Gas Equipment ETF has moved from 51 to 82, or a greater than 50% move since the first week of October. Strength begets strength. Things that hold up better in a decline tend to perform better when the market swings higher. Let's talk about the rest of the groups. We talked about the fact that we started to see relative outperformance in financials in July. That has continued, and we're now trading above both the 50-day and the 200-day moving average. Within the financial sector, interestingly enough, capital markets are leading the way. The capital markets ETF IAI now trading well above the 200-day moving average. The 50-day and 150-day are now trading above the 200-day moving average, and relative strength continues to improve. So energy and capital markets both are expansionary. They're both reflationary sectors. They are not sectors you would want to own if you were going into a deep, deep recession. Market's telling us something. The broker dealers ETF, very strong as well. That's the IAI. We look at the large banks. This is a chart going back to 2008. This is a structural bear market from 2008 to 2020, 12 years where you didn't get a new high. We got a new high in 2021, and we certainly pulled back to the 200-week moving average. But the market's low in June, a higher low in October, and here we are in November trading at about a 6-month high. This is very encouraging because it may be that we're turning into the next leg higher for these large banks, which would mean it's unlikely we have some kind of financial Armageddon in front of us. Industrials started to relatively outperform in March, and relative strength has been making higher lows ever since, now trading above all long-term moving averages. Now, a lot of the strength in this group has come from defense. Companies like General Dynamics and Lockheed Martin, companies that we own, SAIC, Northrop Grumman, but there has been substantial strength in the machinery companies like Caterpillar, Caterpillar's moved from $160 to $235 since September, and certainly could retrace, but showing very strong relative performance, as is Cummins diesel, which we talked about, continued higher over the last 2 weeks. Materials, another reflationary group. Relative price performance improving since June, made a higher relative low in October, has continued to move higher, trading better than 85% of all the companies in the S&P 500. This is the S&P Metals and Mining Index. Again, a group that probably shouldn't do poorly if we're headed to financial Armageddon. Probably does benefit if we have a reopening in China, because we know there's a shortage of commodities, copper and nickel and so on, not to mention what we need for electrification. If you take a long-term picture of the Metal and Mining Index, this is just a tremendous base structure, meaning it's been through a bear market, made a low in 2016, a higher low in 2020, broke out, pulled back into support, and now turning higher. These are all individual clues about what may be happening. It may be that inflation coming down in services and supply chain is fine, but it doesn't look like we're going to see much pullback in commodity prices. Steel looks much the same way, having broken out of a long bear market, retested a rising 200-week moving average, and turned back higher. So technically looks very attractive. Even gold, which has been in a long-term consolidation, breakout consolidation, pulling back to the long-term moving average. These are monthly bars, 1, 2, 3, 4, 5, 6, 7 months. That can feel like a long time when something's correcting, but a nice reignition that took place over the last month. So financials, energy, materials, all things that are reflationary, all things that over time have done well in reflationary periods like the 50s and 60s. When we look at small cap material stocks versus the S&P, they've made a new relative high going back over the last 2 years. And if we take dividend paying natural resource producing companies, the high dividending large cap stocks, again, same picture, breakout, consolidation, and turning higher. This yields over 3.5%. So we've had one end of the barbell that has been reflationary. Things that would do well if inflation is a little bit sticky, or at least inflation in these areas. At the other end of the spectrum, we've had a barbell, the other end of the barbell, that was defensive. Things that are not so economically sensitive, things that are dependable, things that you could hold in a difficult environment. Again, they've continued to do well. Relative price performance for healthcare has been rising all year long, trading above all the long-term moving averages. And in fact, the sector only down about 4% on the year. Biotech has been leading the way recently after a long period of underperformance. Consumer staples as a defensive sector has had a rising relative strength through the course of the year. It's had a nice rally since its October lows. And infrastructure is very similar. So the defensive end of the barbell also has done quite well. There's the longer term picture for this infrastructure ETF. You can see it's seen improved relative price performance since the beginning of this reflationary period, and trading really not far off the all-time highs. So in that defensive camp, we've been focused on dividends. In our income portfolio is aimed at generating a rising stream of dividends to offset rising interest rates. We use the FDL ETF as an example as to how this cohort is performing. We think we found individual equities that have better characteristics, but relative performance for dividend growth has been improving all year long. Small caps, after a long period of underperformance, started to outperform in January, and that continues. But frankly, value as a theme has done even better. So these are all things that are not areas that performed well during the last number of years. But our job, all of us, is to try to identify structural shifts that take place. And once they start, they can go on for a long time. You would be hard pressed to find many portfolios that are heavily weighted in financials or materials or energy. You'd be hard pressed to find portfolios that are heavily weighted in small cap or heavily weighted in value. But this is where the leadership lies. Now, where do people continue to focus? All day long, I hear people talk on CNBC about Microsoft, Apple, Amazon, Google, Meta, and NVIDIA. Relative price performance has been weak all year long. We've had a nice rally in the market since October. No real big pickup in relative price performance. They had a rally during the first bump from June until August, and the relative performance quickly failed the first time market weakness came back and went on to new relative lows. Technology as a group in particular, communications secondary, Meta, Google, Netflix, and so on, and growth as a theme, really trading at relative strength lows versus the market. So it's a bifurcated market. It means you can't be focused on owning the S&P because the S&P is dominated by these sectors. If you take communications and technology and consumer discretionary, it's almost 50% of the market. Now, consumer discretionary in some areas we're seeing some improvement, but that the jury remains out. Mega cap growth as a whole, not the best place to be. So what we've tried to do through the course of this process is say, what has given us better relative performance in the October low versus when the market made its low in June? If something held in better on the second market low, it's likely that they could continue to outperform. So here's a list. There's roughly 80 companies, 80 ETFs that have stronger relative strength now than they did when the market made its low in June, that have an improving relative strength line versus the market, where the 50-day moving average is moving higher, and where the 200-day moving average is moving higher. They are dominated by biotech, infrastructure, industrials, aerospace, financials, silver, interestingly enough, value as a theme, banks, Dow Industrials, healthcare, the groups that we're talking about. So there is some clear leadership in this market. So how are we laying this out in the portfolios? As we sit today, 24% of the equity exposure in the firm is sitting in energy-related securities. Now that's energy infrastructure, oil and gas producers, energy service companies and equipment. It includes solar and include clean energy. That is a multiple of the sector weight for the S&P, but we think it's well justified. Financials make up 16% of the firm's portfolios versus 11% in the S&P, a significant overweight, an overweight in industrials, a slight underweight in healthcare, but a significant weight, and a triple weight of the market in materials. This has been built back up again as the market made its turn in October. Now, in the month ago, we had 30% of the firm's assets in short term, meaning 1 year or less, government bonds. That was basically a place to hold cash. We obviously used that cash since our indicators turned more positive. We have a market weight in consumer staples, which are paying us nice dividends. A significant underweight in communications, a significant underweight in technology, a significant underweight in consumer discretionary, considerable underweight in utilities, and a 0% weight in real estate. This is a market where we have to be targeted. And we have to continue to depend on the facts. What is it that's happening, not what is it that we think should be happening? Because it's easy to justify being concerned about all of the things going on in the world. Outside of the US, interesting enough, the market that is making its first new high in many, many years is the Japanese stock market, currency hedged. So the Japanese yen has been weak, but we can own Japan currency hedged in the DXJ. We own this in our macro portfolio. Mexico making new multi-year highs. And India has made a really nice turn and showed relative improvement versus the S&P since 2020. So we can be in equities, we could be in fixed income, we could be in real estate, we could be in commodities, we can be in any asset class. In some of our mandates, we're able to be short. We've been short fixed income. We are right now short the US dollar versus the basket of world currencies. But we believe we continue to be in a structural bull market in equities. Now, over the last 6 weeks, we've had third quarter earnings reports, which came in revenues and earnings ahead of estimates. So there's a check mark. We've had 2 significant sets of inflation data come in less than expected, CPI and producer price index. We've seen the US dollar back off. We've seen bond yields back off. We've moved into a seasonally strong period of time. In years where the S&P or the broad US market, the Wilshire 5000, had its worst 9-month periods, the periods that came afterwards tended to be quite strong. Not to say you couldn't have a difficult another 6 months, but this was one of those generational bear markets like the financial crisis. We don't believe we're in one of those. 1 year out, 3 years out, 5 years out, and 10 years out, after these kinds of periods, it tends to be you make pretty good money being exposed. We'll use our indicators to test whether, in fact, it continues to support that case. We know that since 1950, if you put your money to work on November the 1st and sold it on April 30th in the period after a midterm election, every single one of those periods was positive. Not to say that's a reason to make a decision, but it's supportive. So we will continue to look for risk as it might impact the markets. We'll look for the market's ability to continue to digest news. But as it sits right now, we think our portfolios are aligned with what's going on in the market. And if it starts to change, we'll be very willing to play defense. So with that, Pamela, if there are any questions, certainly happy to answer them, but we are happy to be out of that September-October period. And I think the market is looking forward to potentially the Fed slowing their rate hikes and some of the inflation data coming off the boil.
Absolutely, Dave. Thank you, as always, for a very insightful overview. We have a question from Ray. He wants to better understand whether you think that oil is in a short or multi-year bull market, and what would be your medium long-term outlook for the sector?
Well, okay, so let's start here. If we were to look at oil, so the oil sector, and there's 2 things. We can look at the commodity itself, and we look at the producers, right? 2 different things. If you take the picture for oil itself, we know that it was in a bear market that went on for quite some time. And we recently, in 2022, broke out of that range and then pulled back. So if we look at it this way, after pulling back into support over the last 4 months, made a nice turn. Now this is off a bar chart. We put the point and figure chart up some weeks ago, showing that there is a lot of support sitting in and around $84. If we've entered a new bull market in energy that goes on for some time, you would expect it, to trade substantially higher. Now we look, in more importantly, at the producers. And so if you look at the XOP index, the XOP, if I looked at the point and figure chart, looks for a move probably 30-40% higher than where we sit today. And so from a long-term perspective, we think that the energy sector producers can perform well because we're not seeing much by way of new production coming on. If you look at the leaders, okay, long-term energy reserves, take a look at Canadian natural resources, for instance. 100 years of reserve life. You broke out, you pulled back over 4 months into support and it turned higher. I think this is the beginning of a bull market. If you look at the natural resource dividend payers, as we talked about, same thing. I think we're at the beginning of a long-term bull market. If you look at commodities as a whole relative to the S&P, they've only recently started to outperform. So if we're in a reflationary environment, this is what you would expect. But I don't think it's what investors expect. Investors are thinking about recession and how bad could it get. Every time we had a down economic cycle over the last 40 years, commodities got crushed. But that's what led them to the point where there was so little capital investment that we're going to run short on supply. We know that we're below 5-year averages on gasoline, oil, diesel, jet fuel. We know in metals we're way below 10-year averages in copper and nickel. These shortages could go on for a long time, and the equities could perform really, really well. If we look at a long-term chart, say of Rio Tinto, take a look here, log chart, and let's make this even longer term. Okay. So last time we came out of a bear market in 2003, Rio Tinto traded from $24 to $130 during a bull market. So if we look at where we sit today, this is only just beginning. So, you could get a 4 or 5 or 6 times return over a period of years. Now, a lot of things have to happen for that to be the case. But certainly, I think a lot of risk has been wrung out over a 12-year bear market. And a lot of these companies pay, really pretty good sustainable dividends.
Thank you, David, as always. The next question is about semiconductors. They've had a nice rally recently. Would this be one of the better tech-related areas to consider allocating to? What is Barometer's thoughts on that space?
So look, the semis have had a tremendous go. This is the XSD, which is an ETF, which shows a basket equally weighted of semiconductor stocks. And, it's had just a massive bull market. And certainly, we've pulled back to the 200-month moving average, and we've had a little reversal here. Of the tech sectors, it's one of the most cyclical. They reprice the goods as demand and supply changes. We know that there was a lot of double and triple ordering when semiconductors were in tight supply. And so that's caused sort of a little mini flood in the market. And that's probably what brought them down as much as they came down. We're going to have to see. We know that Warren Buffett just bought Taiwan Semi after its pullback. So it's had a nice reversal this month. If I had to pick one sector within technology, it's probably one of the most interesting ones. But again, we're going to have to let the market prove it. We have some advanced micro devices. It's one of the small part of tech exposure that we have. But there's going to have to be some work to get us turned on the group. So we start with a small position, and we'll see whether it gets backed. But ultimately, we probably need to do a little bit more bottoming in the sector.
Thank you, David. The next question comes from Kenneth. He wants to know Barometer's view on the defense industry, and specifically if there are any stocks that Barometer has chosen to invest in that we like.
So over the last few weeks, we've actually spent a fair bit of time talking about defense. So if we just take the ITA, it's only down about 6% on the year. So obviously way outperformed. This is relative price performance versus the market. 2 weeks ago, we talked about a number of companies. Things that we own. We own Lockheed Martin, which recently traded to a new high, pulled back a little bit off the highs. Northrop Grumman, which has pulled back a little off the highs, but still very, very constructive. SAIC, General Dynamics. Ultimately, geopolitically, the world has gone through a shift from a unipolar world where the US was so dominant to what is potentially a bipolar world, US and Western countries versus potentially Russia, China, Iran, Brazil, so on. So there's likely to continue to be a ramp up in spending. These are very long-term contracts that come, and defense companies always have additional optionality in the skunk works or the stuff that they've been developing and not talking about. So we think that there's going to be a long-term tailwind for this sector, which is one of the reasons why it's performed as well as it has over the course of the year. So it is one of the sector weights that we have, but of course, there's a bunch of other groups that are doing well also.
Thank you, David. Last question here. Carrie wants to know if the US dollar continues to weaken, what currency should investors rotate into?
Well, historically, in a reflationary environment, you know, Canadian dollar can do quite well. Australian dollar can do quite well. We've started to see a turn in the Canadian dollar. We'll see. If you looked at a long-term picture, this is the FXC, which is see if I can put it up in terms that would be useful. So this is the FXC, the Canadian dollar versus USD, made a low in 2015, which was when commodities made their first low. When commodities made their second low, it was in March of 2020. Now commodities have outperformed, and relative to the S&P, commodities are leading. And Canadian dollar certainly pulled back, but it's pulled back to a substantially higher low than we saw in 2015 and 2020. So we right now are hedging all of our funds back to Canadian dollars, because if we think that energy can be strong and commodities can be strong, historically, the Canadian dollar tends to outperform. Now there's mitigating factors, you know, international investors' views of the Canadian economic environment, which, you know, is challenged with our real estate market right now. But I would say that commodity pricing and energy pricing probably more important. Japanese yen probably is still a bit of a basket case. Euro is tricky. British pound is tricky. So I would stick with the sort of commodity producers, and Australian dollar could do well with a reopening of the Chinese economy, and the Canadian dollar could do well as current commodity currencies do a little bit better.
Thank you, David. Well, as always, we appreciate your time, your insight, and I will leave the final word with you. Thank you so much, David. We appreciate it.
Yeah, well, look, we appreciate folks tuning in each Tuesday. We're going to keep on doing this. If you've got questions we're not answering and you'd like us to address them on the webcast weekly, let us know. If you have questions that you're not comfortable bringing up on a webcast, want to talk about individually, I'm certainly happy to jump on the line. And if you've got questions about some of the services that we provide, we'd certainly be happy to talk about those too. So thanks very much for tuning in, and we'll look forward to seeing everybody again next week. Thanks, Pamela.
Thanks, Dave.